learning trading is a journey, and there are a number of steps that you have to master in order to become successful. We all need to follow a process that brings us from A to B, and during this journey, we'll need to make a lot of changes. We have to change our beliefs about trading, what works and what is appropriate. We have to change our behaviors and start doing what works and stop doing what doesn't work. And we need to establish a routine that we either need to change or establish. That's very, very important. So trading is a business, as you know. It's not a way to, it's not a get-rich quick scheme. There's nothing like that. There is no such thing when it comes to trading. Trading is a business, and income or returns can be variable depending on the business available, which is really the opportunities that the market is giving us. And this that you see on the screen is the 7 pillars of the trading in modern markets, which is one of the models I use when I talk about trading. And as you see, treating trading as a business is very central in this model. So my recommendation to new and experienced traders is always to not try just to make some money, but to learn skills that will serve you for life. And that's the reason why a lot of people who actually start trading or get interested in trading are never successful, because they never learn any skills. And in fact, 95% of traders, unfortunately, lose money consistently. So you will remember that we started talking about our steps. Step number 1, understanding. Number 2, risk management. Number 3, a valid and robust trading edge. Number 4, we spoke about this last week. It's the importance of executing and being able to be disciplined and execute simple trading plans. Today, we're going to talk about money management to reach objectives and how we can really leverage some of the techniques that are little known by starting traders as well as experienced traders to actually increase gains. There is more to that, but again, today we are going to focus on money management. So, what is really money management? If there is a trading secret or a holy grail in trading, that's proper use of money management. Now, there are a lot of conflicts in this industry, conflict of interest, as well as illiteracy. And typically what happens is that you end up either because you believe it's the right thing to do, or because someone else told you, or simply because again, there are conflicts of interest, so there is interest that you trade as big as possible positions. Then you basically end up, when you do that, taking a lot of risk. The reality is that you don't have to take large risks to reach trading objectives, because when you study trading and when you study the trading system development and the best practices in trading, you learn that the way to reach objectives in trading and basically produce large and larger gains is through money management. And it's in a very, very simple way. One of the methods I'm going to show you today is called the markets Monolayer. It's a very simple method that basically splits your account, your own money, as well as the money that you extracted from the market, in different layers and assign a different risk to each layer. So let me explain you what this is all about. The concept here is that we're going to risk small amounts on your own money, and you will take larger and larger risks. Larger risk, not too large. I'll explain you why. On markets money, the money that you have extracted with gains from the market. So this is another way of leveraging OPM, other people's money. A lot of people who want to learn trading, they also want to manage other people's money. And that's a form of leverage. So you have your own money, and then you ask your friends or your clients to offer money to be managed. And that's a way to leverage other people's money. The most basic way to leverage other people's money is to extract that money from the market. As we saw in the previous steps, in order to do that, we need to have proper risk management, and we need to have a valid, robust trading edge that we can use to consistently extract money. So the market money layers basically allows reaching a sizable amount of money, even starting from a very small accounts of 5,000, 10,000 in a period of 2 to 5 years. Now, if 5 years seems a lot to you, well, again, you have to remember this is a business. This is not a quick reach scheme, and you have to be disciplined in order to be able to consistently add to your account. Okay, and the good news is that this can happen from relatively small amounts, for example, $5,000 or $10,000. So again, if there is such a thing as a holy grail in trading, that's actually money management. And I'm going to show you now an example because the proof is in the numbers. So when we look at, and for example, we consider an initial capital of $10,000, and we are able to generate through our robust trading edge, let's say a return on risk of 5 units of risk every month. So let's say that we risk 1%, and we will be able to, if you're able to consistently return 5 times your risk in average, even if you cannot make it all the time, but you can do that in average, then what happens is that you can do really wonders. And here, I'm going to show you now in an Excel sheet. Here, as you can see, if we can make 5 times our risk, and our risk is 1%. So in average, we can make 5% a month. That's an average, which means that some months you do 0%, some months you do 10%, some months you do 2%, other months you might make 7%. But as you can see here, with a simple math here, you can see that by basically making 5% every month, you would end the year with around 70% in gain. All right, and so that's what you can do if you have a stable trading system. Now, obviously, 70%, it's a good return. A lot of people would make a number of bad things in order to obtain it, but it's obviously not something that we can leverage in order to bring a relatively small capital of 10,000 to interesting amounts of money in a period of a few years. So let me show here to you a model, and this is the simple model here. As you can see, again, the actual number is 79, almost 80%, if you're able to do 5% every month. Okay, and as you can see here, my risk in this case is 1%, and the first month, if I have $10,000, then the first month I will risk $100. As you can see, as I accumulate in my capital and accumulate gains, my 1% risk also changes because it's calculated on the capital start, on the starting capital every month. For example, third month here, we will have a risk, a 1% risk of $110 because it's calculated on $1,125 in capital. Okay. Of course, if we change this risk, we can actually increase our return. But as we increase our return, also our risk increases. And as you can see here, if we were to reach 3% of our initial capital on each trade every month with in average 5 units of risk per month, you would see here that you would actually end up with a very large return here. You end up with a 430% return. This is very high, and it's not impossible to get this kind of return if you have a stable trading system that offers you average return in the area of 5 units of risk per month. However, as you can see here, I have highlighted here a simple calculation. What happens if there is a black swan? If the event you are not expecting happens, if there is a flash crash, if there is a huge move and you are ill-positioned, if your stop is not hit, if you make a psychological mistake, or if you have an event like, for example, the Swiss bank actually lowering, actually producing the effects that we saw at the beginning of 2015 on US dollar and euro Swiss franc. So let's say that you have a 20 unit of risk event. If you are risking 1%, that 20 unit of risk adverse event will count for a loss of 20% on your capital. But if you're risking 3 or 5%, if you're risking 5%, you would be wiped out if was to take place. So the point that I'm trying to make here is that if you really are serious about trading and you consider risk management as your job number one, then you have to account for this kind of events happening. And we cannot risk amount of money that put us at risk of losing all our capital and so ending up out of the game. When the money is over, when the money is gone, the game is over. So you now understand that when you hear people saying, I risk 5% or I risk 10% on a trade because it's risk capital, this makes no sense because it does not consider events like this. Okay, so I showed you some of the examples here. Of course, you can increase your final return if your trading edge is robust, which means that you, in average, obtain 5 units of risk per month, and that's not impossible. If you want to have proof that can be done, contact me, and I will also provide you access with the FibStalker trading signals service, and you can see what we're achieving there. Now, what I want to show you is the money management layers. Basically, the money management layers is a technique, whereas we split our capital, as you can see here in this example. In this example, we consider the first 10,000 of our capital as our own capital. That's our starting capital. On 10,000 of our capital, independently from regardless from what we have in the account at the moment, on the first 10,000, we always risk 1%. All right. On the following, on the money that exceeds 10,000, we're gonna use a different risk. For example, in this case, if in the account we have 13,371, then that would mean that we have 10,000 is our first layer and 3,371 in our second layer. Now, if we risk 1% in our first layer and something more than 1% in our second layer, then as you can see here, we can generate returns that are much higher than the returns that we would have if we would only risk a fixed percentage. So let's say that on our second layer, which is the money in excess of our initial 10,000 capital, we risk 3%. What we can see here is that now the final return at the end of the year is very much amplified to 145%. But most interestingly, what happens if we have a negative event, an adverse event, and we lose 20 units of risk? Well, what happens is that on the other people's money here, on the market layer that is related to the market, to the money that we extracted from the market, we're going to lose 60% of whatever we have in that layer at that moment. However, we're only going to lose 20% on our capital here, and that keeps us in the game, and we can actually continue trading. So I hope this gives you an idea of how we can use money management. The total risk, obviously, as we use money management, is going to increase and be above 1%. As you can see here, the last month here, we actually risk 2.1% of our total capital, okay, which is our capital start on the 12th month here, which would be December if you start with January. And so what we're seeing here is basically the possibility of amplifying our returns by thinking of our capital in a different ways and risking different amounts, different percentages on different layers. And this is the whole concept of using money management to reach objectives. We reach objectives not increasing straight away and evenly risk, but we increase risk in an uneven way, and on our money we keep a very small risk. So we don't need to generate big returns. We need to generate steady returns, and then we use money management to reach our objectives. If you want to know more about this, I'll be able to provide more information. Just drop me an email, and I'll be very happy to provide you with additional information. There's one thing I want to add. When we spoke about the trading edge, we spoke about some of the expectancy and opportunity you can expect or anticipate when you use the FibStalker methods coaching program, and when you use the FibStalker methods trading and trading signals as well. There are returns in the area of one expectancy when we use full risk and when we use risk-free, and we also time intraday, then we can generate this kind of profile with 50% winners. We have a number of very high number of scratches typically, and that's the way we manage risk as well. So we actually have break even, and we can have a 30% of losses as well. But when we time the number of opportunity, when we time on the intraday, can be in average pretty high with 30 or even 40 or 50 opportunities